The dot-com bubble was a rapid rise in U.S. technology stock equity valuations fueled by investments in internet-based companies during the late 1990s bull market. During this time, the value of equity markets increased exponentially, with the technology-dominated NASDAQ index rising from less than 1,000 to more than 5,000 between 1995 and 2000. Things began to change in 2000, and the bubble burst in 2001 and 2002, with equities entering a bear market. Hello guys, welcome to Untitled. This video is about the dot-com bubble. The 1990s were a time of rapid technological advancement in many fields. However, it was the commercialization of the internet that resulted in the greatest expansion of capital growth the country had ever seen. Although high-tech standard bearers such as Intel, Cisco, and Oracle were driving organic growth in the technology sector, it was upstart dot-com companies that fueled the stock market surge that began in 1995. The bubble that formed over the next 5 years was fueled by cheap money, easy capital, market overconfidence, and pure speculation. Venture capitalists looking for the next big score freely invested in any company with a dot-com after its name. Valuations were based on earnings and profits that would not occur for several years if the business model worked, and investors were all too willing to overlook traditional fundamentals. Companies that had yet to generate revenue profits and, in some cases, a finished product went public with initial public offerings that saw their stock prices triple and quadruple in a single day, causing a feeding frenzy among investors. The NASDAQ had record capital inflows beginning in 1997. In 1999, internet businesses received 39% of all venture capital investments. The majority of the 457 initial public offerings that year were internet-related companies. The NASDAQ index peaked at 5048 on March 10, 2000, nearly doubling the previous year. When the market peaked, several of the leading high-tech companies, including Dell and Cisco, placed massive sell orders on their stocks, causing panic selling among investors. The stock market lost 10% of its value in a matter of weeks. When the capital began to dry up, the dot-com bubble burst. In the years preceding the boom, record low interest rates, the adoption of the internet, and interest in technology businesses allowed cash to flow freely, particularly to startup companies with no track record of success. Valuations grew, and money eventually ran out. This caused numerous companies to fail, many of which had no business model or product, forcing the market to plummet. By the end of 2001, the majority of publicly traded dot-com companies had gone bankrupt, wiping out trillions of dollars in investment capital. However, the bubble then burst in 2002, and the stock prices fell to around 78%. The America Online Incorporated and Time Warner merger in January 2000 set a new record for the largest merger failure in history. The rise and fall of technology stocks precipitated the dot-com crash. The rise of the internet created a frenzy among investors who rushed to invest in new ventures. Without a business plan, product, or track record of profits, these companies were able to raise enough money to go public. These businesses exhausted their cash reserves, causing them to fail. Amazon, eBay, and Priceline are examples of companies that famously survived the bubble. What caused the dot-com bubble to burst? 1. Investor hype and overvaluation. Because of rising demand and a lack of solid valuation models, most tech and internet companies that went public during the dot-com era were vastly overvalued. High multipliers were used on tech company valuations, resulting in unrealistic and overly optimistic values. The most obvious cause of the dot-com bubble was the hype. Because investors saw these companies as a surefire way to make a quick buck, they hyped them up and overvalued them. However, the majority of them did not yet have the clientele to be as profitable as they appeared to be. Instead of analyzing fundamentals, most investors went on an investment binge in order to profit from rising stock prices. At the time, there was also a media frenzy, which created a very pleasant vibe. 2. The abundance of venture capital. One of the major causes of the dot-com bubble was money pouring into tech and internet company startups by venture capitalists and other investors. Furthermore, cheap funds made available through extremely low interest rates made capital easily accessible. It, combined with lower barriers to obtaining funding for internet companies, resulted in massive investment in the sector, further expanding the bubble. 3. Media frenzy. People were encouraged to invest in risky tech stocks by media companies peddling overly optimistic future returns and the get big fast mantra. Business publications such as the Wall Street Journal, Forbes, Bloomberg, and many investment analysis publications fueled demand through their media outlets, adding fuel to the fire and inflating the bubble even further. 4. Speculation. The market was already beginning to feel like the future in 1995. Computers progressed from a luxury item to a professional necessity, and it was clear that the world was changing. Then venture capitalists noticed it, and the market speculation began. 6. Alan Greenspan's speech. Alan Greenspan's speech on December 5, 1996, is regarded as one of the catalysts for the dot-com bubble. Greenspan, the then chairman of the U.S. Federal Reserve, warned about the financial market's irrational exuberance, which was supposed to bring the market down but was interpreted as a strong signal of confidence. 7. Taxpayer Relief Act of 1997. Another factor that contributed to the dot-com bubble was the Taxpayer Relief Act of 1997. It effectively reduced capital gains tax, making investors more likely to speculate in the financial market. It was also more profitable, and investors had more money to do it. Most of the companies did not have a profitable business or enough clients to keep it that way for a long time, so when the cash stopped flowing in, they faced a downturn. The economic impact of the dot-com bubble. The dot-com bubble not only caused a mild recession, but also shook confidence in a new industry, which had far-reaching consequences. It was so widespread that even successful companies with a long and profitable history were affected. For example, Intel stock, which has been traded since the 1980s, fell from $73 to around $20 to $30. The company was unrelated to the dot-com bubble, but it was still impacted. Prices were higher at the time than in the 2000s, but they took a long time to recover. Overall, the effect was far worse for investors than for businesses. According to the New York Times, approximately 48% of all dot-com firms survived the crash, despite the fact that the majority of them lost a significant portion of their value. For example, the sudden increase in the issuance of initial public offerings by new technology companies, including GameStop, and many technology stocks reaching an all-time highs in 2021, has many investors concerned about the possibility of an economic bubble. However, there is a way to prepare for a similar event. And that is knowing that every bubble adheres to a simple rule: they are all about the hype. By thoroughly researching each company, one can avoid falling for the hype and losing money. Furthermore, rather than investing in a company's future, one should concentrate on how they are performing right now. How to avoid another bubble. The measures listed below can help you avoid another bubble. 1. Proper due diligence. Investment in new startups and similar tech companies should be considered only after thorough due diligence, which includes a closer examination of the company's fundamental value drivers, such as cash flow generation and sound business models. A stock's long-term potential should be thoroughly examined, as a short-term focus will result in the formation of another bubble. 2. Removing expectational investment. Investors should avoid investments based on unrealized potential in entities that have yet to demonstrate their ability to generate cash flow and overall long-term sustainability. Through speculation, expectations lead to the formation of a bubble. 3. Companies with high beta coefficients should be avoided. During the dot-com bubble, most tech stocks had high beta, implying that their downfall in times of recession would be much greater than the average market fall. A high beta coefficient indicates a high-risk stock during a market downturn. Because the opposite occurs during a market boom, investors should be wary of the formation of a bubble. Many bubbles have formed and burst in the past. Have you ever faced a situation like this? Please let us know in the comments section below. Thank you for spending your valuable time with us. We're so glad you did, and if you enjoyed this one, please give us a like. Don't forget to subscribe and click the bell icon to never miss a video. See you next time.